Good afternoon. This is Troy Wirth with Wirth on Wirth Radio. And in a prior episode, we had focused on the life settlement market with Lisa Rayberg of Rayberg Life Settlements. And that really led us to having another guest content expert in Brian Clark of Equilife Life Settlements, the CEO of Equilife Life Settlements. Good afternoon. How are you?
Excellent, Troy. Thanks for having me.
Great. Um, so we want to start by just really focusing on this idea. What is a life settlement? I think we understand the life settlement is the sale of an insurance policy, but how does that work really from the investor's point of view, not from the seller of the insurance policy, but actually if someone may want to participate and purchase this type of an investment for a portfolio?
Well, sure. So when a senior, typically in their 70s or 80s, has sold their policy, as you discussed with Lisa, then an investor group, historically, that's been your Warren Buffetts of the world, Blackstone, national pension funds, a lot of the big players have used this for many, many years as a hedge to their primary holdings. When they sell that, perhaps one of the buyers could be our firm. And what we do is we bundle those up into pools of 5 policies each and offer these portfolios to individual investors in California who are financially qualified. So either they can be accredited or financially qualified with a minimum net worth of at least $250,000, not counting their house, their cars, and their home furnishings. And those are the people that can choose to buy these life insurance policy death benefits as a hedge really to their main holdings, which might be stocks, real estate, et cetera.
Okay. So as you mentioned, it's an alternative investment, so it wouldn't be a cornerstone of their investment. Is there any type of regulations or laws or statutes that have been passed relating to these sort of the validity of this market?
Well, sure. Back in the year 2000 here in California, where we do business, there was a Senate Bill 1837. It was passed and it modified the Department of Corporations Code, now called the Department of Business Oversight Code, really the California state securities laws, to regulate this particular investment. It states who can offer it, who can invest in it, and everything that has to be done to be compliant in that offering. And so as an investor, you always want to make sure that there's some, legal framework that the investment you're making, is operating under. It gives you some level of protection as an investor, and that's important.
So can anyone, you mentioned accredited investor, is it possible for someone who's not an accredited investor also to invest in these?
Correct. That's the $250,000 net worth, not counting 3 things: your primary residence, your cars, and your home furnishings. That's the way the law is written. And if you are financially qualified but not accredited, so that accredited level, you probably know it if you are one. But for those listening, if you have a net worth of $1 million, not counting your primary residence, there's also some income tests that are also an option. But really, net worth wise, it's $1 million, not counting your primary residence. So if you're between that 250 and $1 million, so you're qualified but not accredited, the law limits you to no more than 10% of your net worth, and we think that's a good spot to be in as far as a maximum exposure to this particular asset class.
Okay. One of the aspects of your company and your strategy, I think that's valuable is you've done this as a pool of 5 policies. Obviously, it's 5 different policies on different people. Can you talk a little bit about how you build your portfolio and sort of what's the maturity of the portfolio and possibly any drawbacks to how the investment works relative to other investments?
Sure. So you're right. What we do is when we acquire these types of life insurance policies, we package them up into portfolios of 5 policies each. Now, as an investor, you can participate in multiple portfolios, but let's just take one for an example. If you bought in to a piece of these 5 policies, your returns are going to come back to you upon the maturity of each one of those 5 policies. So as each of those insureds And again, these are people typically in their 70s and 80s that have some health issues. As each one passes and the death benefit is paid out, that's when you realize your return. And so typically, a $10,000 investment is going to yield somewhere between $16,000 and $19,000. Therefore, a $100,000 investment would yield between $160,000 and $190,000 in future death benefit. Now, that's the upside, and you don't have to wait till all the policies have matured to get your gain. You're going to get it in 5 different chunks, periodically or episodically, as each insured passes. Conversely, the risks are really that this is an illiquid investment. It's a buy and hold growth type investment, because you don't quite know when you're going to get your payout back. You have an idea, because when the insureds sold their policies, they had to turn over their medical records, and an underwriting laboratory reviewed those medical records and came up with a life expectancy estimation. Those typically range between 3 and 8 years. So people can live less time than expected or longer than expected. And that brings in the other primary risk. Liquidity was the first one. Longevity risk would be the second one. And that's really, even though we've studied the medical records and actuarial sciences are pretty good, nobody knows for sure exactly when someone's going to pass away. So you as an investor need to understand that the money you put into this, is money that you can wait some period of time to receive your gain on.
Okay.
And of course, the longer they live, the lower your annual rate of return, and the shorter time until maturity, then the higher rate of return you'll get.
Okay, understood. Well, the in those numbers that you mentioned, say once 100,000 pays out, let's say it pays out, you said 160 to 190, let's say it pays out 170. What would be in that, just mathematically in that portfolio? I mean, what would be the scheduled sort of life expectancy or the final maturity within that portfolio, on an average basis? Obviously, you've got outlier one way or another, whether that person passes before or after the expected time frame. But what would be the anticipated maturity of a portfolio for all 5 to be mature?
Sure. So we target a 12% simple annual rate of return, and that's if the insureds, all live exactly to their life expectancy. So in terms of a compounded rate, we're hoping for a decent single-digit average annual rate of return, all the way up to potentially a low or even mid double-digit type return. So perhaps anywhere from 5 to 15%. Now, as you stated, we don't know for sure. So it could always be worse. It could always be better. But that's kind of generally the range of the experience base of the asset class, and a reasonable set of expectations. But again, any portfolio could always shake out better or worse than that. But we try and do what we can to buy policies that we believe make for good investment opportunities for our clients.
Okay. Um, the What is the actual the process if I have a client or a person who's listening is interested in investing in your portfolio? What is the process that they would go through to have an engagement? What are the minimums? And what type of monies? Is it just regular cash on hand after tax investments, or could they use IRA monies? And how would they go about the engagement with your firm?
Sure. If a person thinks this sounds interesting, they like the idea of investing like the big smart money, the Warren Buffetts of the world, and they like what this can bring to their portfolio, they can use cash type after tax investments. They also can use IRA or Roth IRA type investments. The minimum for cash investments is only $10,000, so it's very bite size. You don't have to sock a huge investment in to try it out. For qualified money, that's your Roth or IRA type investments, that minimum is $25,000. And so once you're in as an investor with us, you can always make additional investments for as little as $5,000 typically, and buy pieces of additional portfolios once you already have met our minimums. So it's not something where you have to have millions of dollars or billions of dollars like the big players we've mentioned. It really can be a modest slice of your portfolio to be a hedge.
Okay. So for example, right now at this moment in time, how many portfolios do you have? As you mentioned, obviously as a matter of diversity, I think it's having five insureds in a pool is good diversification. But if you can get more, all the better. How many portfolios do you have actually in play at this moment?
Good question. And at the moment, we actually have two portfolios running. We are about to sell out of our last portfolio, and we have launched our next one though. And we recently announced a maturity from a past portfolio, and it was an excellent return. But for that reason, we went ahead and launched the next portfolio. So we do have two available right now. So all things being equal, if someone has the funds available and this makes sense to them, they could split that into both portfolios at the moment. And then, in 3 or 4 months, we'll probably launch the next one and so on and so forth. So you can always pick up a piece of our new portfolio as either you come into other monies or sell another investment, or get a maturity payout if you're an investor with us and choose to reinvest that. That's really the best way we believe to approach the asset class. Because to your point, 5 policies is better probably than 1 policy, and 10's better than 5, and so on and so forth. So if you're using this to diversify, we also recommend that you diversify among this investment as well as much as you can.
Sure. How it just seems like such a strange market and a concept probably for a lot of people. I mean, how vibrant is the market? How many of these policies actually exist? Is there a continuing pipeline of policies that there are senior folks who want to sell a policy, or who are maybe their hand is forced to get rid of a policy? How vibrant is the market?
Well, with the current demographics that we have in this country, it is actually a very vibrant market. There are billions of dollars of life insurance policies that are sold through a life settlement transaction each year. And that's really stemming from the fact that we have the baby boomer generation getting to an age where now they are older. Maybe they're not in as good a health as they were when they bought their policies, but also the reasons why they have the policy may not be around anymore, perhaps either because of an early passing of a beneficiary, or there's been a divorce, or estate tax laws have changed. There's a number of reasons why someone would maybe want to sell their policy. And in your recording that you did with Lisa Rayberg that you referenced earlier, I'm quite sure she probably walked through a lot of those reasons. But with the sizable demographics of the baby boomer getting to that age, there are a lot of policies. And as more and more investors learn of this asset class and figure out basically why the big smart money has used it, then there's a pretty good appetite out there from an investment standpoint as well. Adding to that is the fact that we're 11 years deep into a bull market in the stock market. Real estate valuations are up again. Interest rates are still very low. And so investors are seeking return, but they don't necessarily want to step in with new money to a stock market that's this far into a bull run, not knowing what the future is going to hold. And so when you look at what your options are, we believe that it's more attractive and timely than ever.
And how about just as a general rule, privacy? Do we know the names and numbers of the folks that are in the portfolio?
No, actually, we're fully HIPAA compliant when we acquire policies and offer them for investment. As you might imagine, it would not be a good thing to be sharing that information with investors. And therefore, we're very careful to keep the information private. You do, as an investor, get to know a lot about the insured. You know their health conditions. We show you before you ever invest. And you asked me earlier about the process. A first step would be to take a look at our portfolio, look at the underwriting reports for each of the insureds in a given portfolio, see what the return is, gauge for yourself whether you believe that this is a sound investment. And then if you would like to move forward, it's a simple matter to figure out what kind of funds you want to use, again, cash or IRA or Roth, how much makes sense for a given portfolio, whether you want to participate in, for example, both portfolios that we have. And then we do everything by DocuSign. So it's a very easy, simple process. It all goes very quickly and easily nowadays through the computer. And we're still battling the coronavirus at the time of this recording, and so this is something that you don't have to get together in person. It's all pretty quick and easy via DocuSign.
Well, it's a very different look to look at this really from the investor's side. Of course, myself more as as an agent and helping clients with insurance. It's interesting to look at this from the investment side. And I think apart from asset allocation, the liquidity, obviously the lack of liquidity, and perhaps the time frame, to wait for the return on money. It certainly seems like it is an asset class that a lot of people who have a balance sheet, who've got assets on their balance sheet, should certainly be looking at for their portfolio.
Definitely, and for those reasons too, that kind of explains why a decent portion of our investments are IRA or Roth IRA, because if somebody's in their 40s or 50s or even 60s, that money is typically earmarked for down the road, and so the time horizon can make sense. Tax treatment, depending on their tax situation, it might make sense. And again, we don't give tax or legal advice. We always have to say that. However, um, that that is really not a bad place to hold this particular investment, is with qualified funds.
Right. Yeah. Essentially, being able to maintain some level of tax control is right, because it's not taxable until the monies are distributed. And so when those funds, just as an example, you have a maturity on one of those, the 5 pieces of the portfolio, when that matures, those dollars in the form of a death benefit just go into the IRA account. And so that kind of brings me to another piece of it. How do you hold these assets? Is there a third party institution that holds the IRA money, or is this money held in trust, or how are the policies held, even in terms of a titling, in case the investor passes away? How is that asset titled to transfer to either the beneficiary or an estate or so forth?
Very good question, and it's a very important part of our model here at Equilife. When we acquire policies, we don't keep them on our books, and that's important because something could happen to our company down the road. We don't anticipate that, we don't hope for that, but it would not be prudent to keep the policies on our books. So what we do is we utilize the services of a large trust and bank in the form of First Western Trust, and they become the owner and beneficiary of each policy and therefore each portfolio. And so what our investors own is a certificate of beneficial interest in each portfolio that they have ownership in. And that's what can pass on to an heir if they pass. Now, if they used qualified money, then we need to use the services of what's known as a self-directed IRA custodian. We partner with IRA Club, and we can work with others, but that's really our primary custodian. And that way, if you do have IRA funds, it's a simple matter to do a transfer. The money, as you pointed out, stays in the IRA, therefore it stays in that tax favored, either deferred, or if it's in the case of a Roth, tax free, it stays in that status. And so even when we make a payout, the money is going to go back to that IRA custodial account for the benefit of the investor, and the beneficiary structure of that account is in place to ensure that it passes to a spouse or your heirs should something happen to the investor related to this particular investment. So whether you use cash non-qualified money or whether you use IRA or Roth, you've got avenues both ways, but overarching all of it is very important, our usage of that third party trustee to hold the policies. And that's what you have ownership of, is those trusts. We feel that's a very important part of our model.
Yeah, no, absolutely. Last question: how long has Equilife been around, and really, what is what's the mission of your of your organization, of your company?
Sure. Equilife was started in 2018. However, the founder and both myself, we have years of experience in the space, going back to probably about 2012. And um, we really feel like, it's our mission to bring this asset class that historically has been reserved just for the big players to the individual investor. We want to take that institutional level um, ability to have a profitable hedge, and we want to make that available to the financially qualified individual investor here in California. And we feel that our model, compared to others that have been conceived over the years, is superior, both in terms of giving people policy diversification, as well as managing the portfolio over the years going forward.
Well, it's really, it is a pleasure to have you on the show, and I think it's also interesting and worth noting, as you have already said, the Warren Buffetts of the world have this as a part of their portfolio in a Berkshire, these other investment vehicles. So for a lot of investors, they have deference to those investment managers, and they perhaps don't even know that they have exposure to these asset classes. So to be able to actually give that individual investor and qualified investor actual direct access to this, and to be able to toggle it as part of a portfolio, I think is really a refreshing strategy, ability that you offer to the average investor.
Thank you. And yes, we agree. It's actually kind of fun to open people's eyes to what's out there that they may not be aware of, and we feel it's important that they ask the question of, if Blackstone's been buying billions of this, if Warren Buffett owns, a lot of this investment, what do they know that maybe I don't? And we compliment people that take the time to educate themselves, because once their eyes are opened, we believe that they, if appropriate for their situation, we believe that they'll think that this makes a good slice to their portfolio, to act as that hedge, to act as that shock absorber the next time we have, a market, decline or meltdown. And that's, could be tomorrow, could be some years from now, but whenever it happens, you probably will be glad you have some part of your portfolio that won't be affected and dragged down with the other things that may have trouble someday.
Yeah, it's always best to take money off the table when you're winning, and people have been winning
Yep, the old
quite a
the
while.
old phrase of you know get while the getting's good, or don't wait till the horse is out before you close the barn door, right?
Yeah.
Our phones ring off the hook whenever the market goes down, but that's after people lost money. We try and encourage folks to do it ahead of time, like you said, sell high.
Yeah. We all have funny analogies for that stuff. I always say I like to get to the party early when the hors d'oeuvres are fresh, and leave, before people are swinging from the chandeliers and things have gone south. So, I mean, that's,
Sound as well.
yeah, sound advice, maybe a corny version of it. But I think the other last point worth noting that's can't be overemphasized is that this senior market, I mean, these folks are actually going to toss a policy into the trash can, or maybe just get a pittance, particularly in the notion of a universal life policy, where maybe the cash value has been stripped out of the policy because they've been sort of systematically underfunding a policy, and they're still alive, and the amount of premium that they might have to pay is just doesn't fit their budget, and it just doesn't make sense economically to keep the policy. Having a market like this that's healthy, where there is a market to purchase those policies, is, I mean, stop short of saying, it's almost a service to that senior market, where they can recapture some monies that were spent on policies that didn't coming to fruition.
Absolutely. And that's really the biggest hurdle for folks that don't understand the life insurance industry, that don't understand the circumstances that you just described. Because when they first hear about this, they think it's maybe an odd or perhaps even a morbid way to make money, not realizing that actually it becomes a socially responsible way to invest when you realize the value that it's giving to seniors and the value that can be had as an investor. It truly can be a win-win type of situation. And with that level of understanding, then people realize the benefit not only to themselves as an investor, but also what the secondary market for life insurance can mean to a senior selling their policy. So it's a whole system, and we just love when people take the time to educate themselves, like your listeners are doing, hopefully today. And when they do, good things can happen.
Sure. Well, I want to thank you for coming on the show today, and we will have your information there on screen at the end of the show. And I appreciate you taking time out of your day to share this interesting opportunity and market with us.
Absolutely. Thanks for having me, Troy.